Hello, investors. I have been sitting with some data about UAE stock market for a while now, and I need to show you something. Not to scare you, not to hype you, just because every single person who is investing in the UAE or even thinking about it deserve to see what 25 years of this market actually looks like. We are going to look at Abu Dhabi Stocks Journal Index, the FADGI, all the way from 2001 to 2026. Crashes, bubbles, oil shocks, a global pandemic, all of it. And what I want to show you is not just what happened, I want to show you what the data tells us about what a patient investor could expect and what a panicked investor actually got. Spoiler, the patient investor won, but not in the way you would expect. I built a full dashboard. Every tab tells a different story. Today I'm going to walk you through all of it, one section at a time. By the end of this video, you should be able to look at any market dip, any crash headline, and know exactly how to think about it. Let's go. Before we dive into the numbers, let me take few seconds to explain what we are actually looking at because if you have never heard of FADGI, the rest of this won't mean much. The FADGI, Abu Dhabi Stock Exchange Journal Index, is essentially a report card for Abu Dhabi stock market. Think of it like this: when you invest in a fund that tracks this index, you are buying a tiny slice of Abu Dhabi's economy, the biggest company all in one basket. I went back to the very beginning of the available data, May 2001, and I tracked every single month up to March 2026. Here are the four headline numbers that frame everything else we are going to talk about today. Time period covered, May 2001 to March 2026, about 24.8 years of investable history. Total return 965. The index went from 898 to 9566. Long run CAGR 10% per year, every year compounded. Maximum drawdown 63.8%, the deepest single fall in this entire period. 10% per year sounds boring, but run that on a calculator for 15 years and it will quietly change your life. We will show you the math in a moment. Now, that 10% CAGR means if you had put 100,000 dirhams into the market in 2001, just sat there, done absolutely nothing, you would have crossed 1 million by now. But the path to that million was not a straight line. It was a ride that would have broken most people. And that's exactly what the first chart shows us. Let's open the overview tab and look at the full picture. Look at this chart. The top half shows the FADGI level over time. That's the actual price of the index. The bottom half, those red sections, that's the drawdown map. It shows you how far the market was below its previous all time high at a given moment. This bottom chart is the most psychologically important thing you can look at as an investor because what it tells you is at this exact point in the time, if you had bought at the peak, here is how much you were down. You will see three massive red zones. The first one around 2005 to 2007, that was a local retail bubble. People were borrowing money to buy stocks. Classic bubble behavior. Then it unwound. The index fell 53.7% from peak to trough. The second one, 2008, the global financial crisis. Oil price collapsed, global liquidity dried up. This market fell 55% from the peak to trough. That's a market cut in half. The third one, COVID, March 2020, the fastest crash in this entire duration. The index dropped 23.8% in a single month. 1 month. Now look at these headline takeaway on the right side of the screen. Best single month in 25 years, March 2005, up 43.2%. Worst single month in 25 years, March 2020, down 23.8%. Best full year 2004, up 74.8%. Worst full year 2008, down 47.5%. 75% up in one year, 47% down in a different year, same index. This is why people who try to time this market usually get it wrong. Now, here's the table I want you to pay close attention to. It answers one simple question. If I invest for 1 year versus 3 years versus 15 years, which gives me the most reliable return? And the answer is not what most people expect. 1 year holding period, highest average CAGR at 12.67%, but you only won 60% of the time. Volatility of 31.5%. That is chaos. 15-year holding period, average CAGR drops to 7%, but you won 90% of the time. Volatility drops to just 3%. That is calm. The dashboard grades these like a school report card. 1 year gets a C, 15-year gets an A+. The lesson, as you hold longer, reliability improves faster than returns fade. Time, not timing, is the edge. Now, this leaderboard is a summary, but to really feel what these holdings period looks like in practice, we need to click into the rolling returns tab and see the data come alive. Let's start with the 1 year view. Look at this return path. It's all over the place. Up 68% 1 year, down 3% the next, back up 20%, down again. And if you look at the most recent window, 2021 was up 68%, but 2017 was down by 3.25%. 2023 was down by 6.2%. That is what 1 year investing in this market look like. It's not investing, it's guessing. Switch to 3 years, a bit smoother, but still bumpy. Average CAGR looks good at about 9.8%, but the volatility is still high at nearly 17%, and your win rate is around 70%. Meaning, 3 out of every 10 people who invested for exactly 3 years and then took their money out lost money. 5 years. Now we are getting somewhere. Win rates moves up to 81%. The swings are starting to flatten. But look at the worst window, 2005 to 2010. If you bought at the top of the bubble and sold exactly 5 years later, right through the Gulf financial crisis, you still had a negative return. Timing still mattered painfully. 10 years, win rate of 87.5%, volatility drops to around 4%. You can visually see in the chart how the line is settling. The worst 10-year window in this data set, 2005 to 2015, you made 2.31% per year. Not exciting, but you did not lose money. Best 10-year window, 2012 to 2022, 18.35% per year. That turns 100,000 dirhams into over 560,000 dirhams. And here is the A plus grade, 15-year holding period. Win rate 91%. Nearly 91 out of every 115-year window in this market made money. Worst 15-year window, 2005 to 2020, that covers the bubble, the GFC, and the decade of slow recovery. Even then, you made money. The best window is 2008 to 2023, starting at the height of the GFC Gulf financial crisis panic, holding for 15 years for that moment gave you the best 15-year return. The best 15-year return started in 2008 when the world was ending, when every headline was screaming doom, when your neighbor was saying sell everything. That was the moment. This is not the advice, this is data. And what it tells us is that time, not timing, is the real edge. So we know what's holding looks like. But what happens if you are also adding money every month? What if you are building a position slowly over the time? That's exactly what the next step answer, and it might be the most important section of the whole dashboard. SIP stands for Systematic Investment Plan. Simple concept. Every single month, no matter what market is doing, you invest a fixed amount. You do not check the price, you do not wait for the perfect moment, you just keep going. Now the dashboard tested two type of investors. Investor A stays invested every month, no matter what. 1000 dirhams every month for the full 25 years. Investor B, the fearful one. Every time the market drops more than 20% from its all time high, they pause their monthly investment. They wait until things feel calmer. Stay invested, final value will be 854,184 dirhams. Pause on crash, final value will be around 416,000 dirhams. Wealth gap is 437,000. Month skipped by the fearful investor is 160 month. Investor B missed 160 months, that is 160,000 dirhams in contribution they didn't make. But their final wealth isn't just 160,000 dirhams less, it is 437,000 dirhams less. Why the gap is so much bigger than the missed contribution? That's the story this next chapter tells. When the market crashes, your 1000 dirhams buys more unit. Think of it exactly like a sale. When a shop marks everything 50% off, you don't walk away, you buy more. Market crash is a sale, and investor B walked away from it every time. Let me show you a specific example. During the 2008, at the peak in May 2008, 1000 dirham bought you 0.20 units of the index. At the trough in January 2009, the same 1000 dirham bought you 0.44 unit. That is 2.23 times more for the same money. The fearful investor paused right at that moment. They stopped buying exactly when the sale was at its biggest. Now look at this recovery table. This is genuinely fascinating. The 2005 bubble unwind in the index itself took 193 months to recover to its previous high, that is 16 years. But the SIP portfolio recovered in 36 months, 3 years. Why? Because during those 16 years, while the index was underwater, every single month you kept buying cheaper and cheaper units. By the time index finally recovered, your average cost was so much lower than the peak price that you were profitable far sooner. The SIP investor who kept going through the worst crashes in Abu Dhabi's history recovered faster than the index itself. They got rewarded for being boring. One more table I need to show you. This is possibly the most important piece of data in the entire dataset. We took 100,000 dirhams invested from 2002 to 2005 and we asked what happens if you try to be clever? What if you sit out the bad years but accidentally miss the good ones too? Stay invested every full year. 100,000 dirhams will be 751,000 dirhams. Miss just the one best year and it's land to 429,000 dirhams, a 43% reduction in the wealth. Missed the three best years, it went down 80%. Missed the five best years, and only 60,000 dirhams left. Missed the 10 best years, 28,000 dirhams remain. You lost nearly everything. The best year in this data set was 2021, up 68%. If you were sitting in a cash that year waiting for a better entry point, you missed the biggest single year rebound. This is the exact trap that most market timers fall into. They get out at the bottom because the news is scary. They wait, the market rebounds fast and hard. They get back in when it feels safe, which is usually near the next peak. Now we have seen the full index history and we have seen the SIP analysis. But one thing I haven't covered yet is whether Abu Dhabi's market today is same it was in 2005. And the answer is it's not. Next step breaks that down. The Abu Dhabi market has had two very different personalities. Era 1, the oil led build out, May 2001 to December 2010. Era 2, the diversified expansion, January 2011 to March 2026. Let's look at the numbers side by side. Oil led era 2001 to 2010 CAGR is 12.3%. Sounds great, but volatility of 28.4%. Max drawdown of negative 63.8%. More than half the months were positive, but when it fell hard. Diversified era 2011 to 2026, CAGR of 9%. Lower, but volatility dropped to 15%. Max drawdown by 29.8%. More stable, more institutional. So, what happened between 2010 and 2011? The UAE started actively diversifying away from oil. Abu Dhabi Economic Vision 2030, Operation 300 billion, a deliberate policy shift to grow non-oil sector, and you see it in the data. The market become more calmer, broader, and more resilient. Annualized volatility roughly halved, peak to trough damage become materially shallower. When people ask, is Abu Dhabi too dependent on oil? The market data says it was, and it has been actively correcting that for the past 15 years. The market you are investing in today is not the same market your parents might have feared of. Understanding the market's character help us understand the investor's choice, and that's what the final big tap covered. Difference between simply holding and trying to trade your way to a better outcome. This one might change how you think about trading. Everyone wants to know this. What if I just timed the market perfectly? What if I bought at every bottom and sold at every top? Fine, let's look at that honestly. We tested three investors, all starting with 100,000 dirhams. Investor 1, buy and hold, puts the money in, does nothing, goes on with their life. Investor 2, perfect cycle trader, buys at every major bottom, sells at every major peak, gets timing exactly right on every single major move. Investor 3, late re entry trader, same strategy but misses the re entry by just 1 year after one of the major trough. Buy and hold, final value 1 million dirhams. CAGR is 10%. Perfect cycle trader, final value 12 million dirhams. CAGR is 21%. Late re entry trader, final value is around 10 million dirhams. CAGR is 20%. 12 million versus 1 million dirham. Yes, perfect timing wins massively. But read the honest description of what the perfect cycle trader actually had to do. Buy near the bottoms, sell near peaks, sit in cash without panicking, without chasing rebounds, without second guessing yourself. That is the real challenge. Because in practice, most people do the exact opposite. They buy after the market has already gone up because it feels safe. They freeze during crashes. They return after most of the recovery has already happened. Investor 3 was 1 year late, just 1 year after one drop. Their final wealth dropped from 12 million to 10 million. Nearly 2 million gone from one single timing error, 1 year. The strategy scorecard calls perfect timing very hard. It calls buy and hold easiest. And its verdict on buy and hold solid, low maintenance compounding. That's not good, I know, but 1 million from 100,000 dirhams while you were sleeping, that's not bad either. So, what does the practical path look like for most of us? The dashboard actually lays this out clearly. 70 to 80% of your equity capital stays in long term buy and hold. SIP into FADGI linked ETFs. Set it, let it compound. The remaining 20 to 30% you keep as dry powder, cash or near cash, ready to deploy during major dislocation. When the market is down 30% or more from its previous peak, you don't need to catch the exact bottom. You just need to be roughly right, roughly brave during the big panic windows because that is when the sale is on. Now that we have seen all the data, I want to talk directly to different people watching this because your situation changed what this data means for you specifically. Not everyone watching this is in the same place. So let me speak to three different people. If you are just starting out, You are in the best position, and I mean that genuinely. The 15-year data just told you that if you start today and hold for 15 years, your probability of making money is 91%, not 60%, not 70%, 91%. You don't need a big lump sum. A monthly SIP, even with 500 dirhams starting today, compounded for 15 years and 10% turns into something real. And think, what if you step up by just 10%? And that's the topic for another time. But the market will crash before your 15 years are up, guaranteed. And when it does, do not stop. That is the moment your money buys the most. If you have been investing for years, the most common question I hear, the market feels high. Should I pause? Here is what data says. Trying to time a re entry is dangerous. We just saw what 1 year of bad timing cost. Staying the course beats waiting for perfect condition. Perfect conditions do not exist. If your horizon is still long, hold steady. If your horizon is 3 to 5 years, your allocation matters more. The 3 year and 5 year data showed you can have negative returns in those windows. If you already have a decent portfolio, well done. Getting here is genuinely hard. This is where hybrid strategy comes into its own. You have something to protect now. So the core stays anchored 70 to 80% in long term diversified holding. The remainder gives you optionally to be opportunistic during crashes without risking the base you built. And if you want to explore active trading, individual stocks, sector bets, fine. But treat it as a separate pot, not the core engine. Build the foundation first, then you can afford to take calculated risk on the top. Before I close, there are three specific mistakes I see again and again, not because people are stupid, but because the market is designed to feel safe when it's expensive and dangerous when it's cheap. Let me name them clearly. See, mistake one, pausing your SIP when market falls. We showed you the cost of 437,000 dirham in lost wealth. The months you paused were the months that mattered most. A market dip is not a warning signal, it's a discount. Mistake 2, trying to avoid bad years without risking missing good ones. Miss the three best years and your 24-year return drops 80%. The best years and the worst years often arrive back to back because the recovery after crash is usually sharp and sudden. If you are in a cash when it starts, you miss the whole thing. Mistake 3, trading before the foundation is built. Active trading is a skill. It takes time, data, discipline, and emotional control. The data showed us that even a near perfect trader loses money, a massive portion of their advantage, with just one timing error. Go, please check about trader Bill Wong, who lost 20 billion in just 48 hours. Build the SIP base first, let it grow, then if you want to add active trading on top, do it with a portion you can afford to get wrong, not the other way around. We have covered 25 years of data, 5 dashboard tabs, 3 type of investors. Let me bring it all back home. Okay, let me bring this back. We just walked through 25 years of data, crashes, recoveries, bubbles, a pandemic, oil shocks, two complete different market personalities. And here is the one thing I want you to take away: not a strategy, not a trade idea, a mindset. Markets are not smooth, they never are. They go up, they crash, they recover, they go up again. That is not a bug, that is the feature. Because without the crashes, there are no bargains. Without the fear, there are no opportunities. The investors who built real wealth in this market were not cleverest ones. They are not glued to Bloomberg every morning. They were the ones who had a plan, started early, kept investing through the scary part, and gave time enough room to work. 25 years of data say this market rewarded patience with 10% annual return. It rewarded patience during crashes with faster recovery than the index itself. It rewarded consistency over perfection. That is the opportunity sitting right here in the Abu Dhabi. The dashboard I built, I will link it in the description below. Go explore it, click every tab, run your own numbers, make it personal. And if this video helped you even a little bit, share it with one person who is sitting on the fence of about investing. Sometimes all someone needs is to see 25 years of data laid out clearly and understand that long game played consistently has historically worked. That's it in this video of Invest Money UAE, and I will see you in the next one. Thank you. Happy investing. Masalama.